So tēnā tātou katoa, ko Unicia Veer tōku ingoa, ko papa mō tōku whenua kura, ko Maua te maunga, ko Toroma te moana, no Aotautahi aho. So kia ora and welcome to the Sorted Money Month webinar. My name is Unicia and I'm your kai whakahaere, your facilitator for today's session. It's fantastic to see everyone joining us from around the moto. I'm always quite keen to see where everyone's joining us from. It's just everywhere around New Zealand. So thank you for joining us here today. And by us, I mean we've got Te Arohanga Order, the Retirement Commission, who are the people who have pulled together all these resources for us today. And Sorted is the public face that you're probably more familiar with, especially with that little orange logo, and you'll get to see the mouse as well. That's the other familiar icon when it comes to Sorted. So they provide the guides, the tools, and the social media channels that we have there as well. My name is Unicia. I'm a chartered accountant. I'm an ex-auditor, ex-financial mentor. I've been a sort of facilitator for nearly a decade or so now, and more recently I changed my career to be working in financial advice. So that's where I sit today. We also have Tom with us on this webinar. So Tom Hartmann is the Te Arohanga Order's personal finance lead, and he'll be dropping in through the Q&A sessions to just give us a bit of wealth of experience and his insight there for what he can bring to the table. So looking forward to having Tom join us in these sessions. So just a reminder, Sorted provides free, independent and impartial information around all things money matters. Sorted is run by Te Arohanga Order, the Retirement Commission, and their aim is to empower the people of Aotearoa on their journeys to a better retirement by helping them understand money. During these sessions, we cannot give you any specific financial advice, and I know it would be tempting, especially considering the topic of KiwiSaver and investing. But what we will do is give you some great resources that you can use to make more informed financial decisions in this particular topic. So take notes and also just make note of any resources that we go to, any websites that you can go back and have a look at later on. So as I mentioned, this is the second webinar in this series. We've got 2 more coming next week and the week after as well. So hopefully you'll join us for the rest of the series as well. But last week we talked about how to best get the best out of your money and set money goals and really boost your financial well-being. So before we go any further, let's set the scene with our karakia. This is a way just to bring us together and really focus us in on the session that we have ahead of us and our financial journeys as well. We've got the translation there in front of you if you want to join along. Tuia e ronga, tuia e raro. Tuia e roto, tuia e waho. Tuia ki te Arohanga Ora, kia whaihua, kia ora. Tomi e, hui e, tai ki e. So what is the topic of today? We are supercharging our savings, looking at how to optimize our investing in KiwiSaver and beyond. So we'll be doing that by looking at the differences between saving and investing and understanding what works best for you. We'll be breaking down a really key concept of compound interest and learning how we can get hold of that to really maximize our returns. We will be doing some myth busting. It's really important to bust those myths around KiwiSaver so we can really focus on how we can best utilize and help KiwiSaver sort the retirement that we want. We'll also be discussing managed funds and how to get on the action of investing beyond KiwiSaver as well. So how we'll be running the session, we'll be sharing with you some key information to get you started on making the most of your saving and investing journey. You will have plenty of opportunities to share your thoughts and ask questions, and we will refer you to the sorted guides and tools along the way as well. So thank you for everyone who's hopped into the chat and said hello already, but please use that chat throughout this whole session. And we have a whole team of sorted experts sitting in and checking your chat as well and just keeping an eye on the questions. So if you've got any questions, hop in there. If I miss it, the team will be picking it up and we'll address those questions as we go along. So this section, in this first part of this webinar, we'll be looking at some fundamental key definitions really. So saving and investing, what is the difference? So we will be looking at some fundamental knowledge that some of you may already have, but it's really important to start knowing that we're all on the same page. So when we think about saving and investing, let's launch a poll here. I wonder if we can explain the difference. So you've got a poll just in front of you, hop on and just quickly, is it not a chance? I think I can, or confidently I could say the difference between saving and investing. Got quite a range of responses going on here, so that's really fantastic. Very good. All right, I think most people have had a chance to hop into the poll there. About 150 or so people responding. So let's share those results. Very cool. So we've got a fair few people who think they could confidently explain the difference between saving and investing. Most think they can. So that means that you've got a pretty good understanding, but whether or not it's solid, you're doubting yourself a bit there. And a few people just saying not a chance. That's not something that they can tell the difference. So let's get in. Tom, did you have anything you wanted to say with that one?
Well, just to say hello to everybody, and also to note that these two terms get confused all the time when people talk about retirement savings. They're actually talking about investment funds. So it's really key that we get this straight here.
Absolutely. So when it comes to saving, the real thing there is saving is setting aside money. So we're talking about cash when it comes to savings. So that's really basic, just to keep that idea in mind. Saving is setting aside money. Whereas investing is a little bit more than just setting aside money. Investing is a bit like going shopping for assets, and that these assets, they spin off an income for us or they grow in value. So assets are essentially when we talk about investing, assets are the 4 different asset classes. So cash, so that's one of them, bonds or fixed interest, property, and shares. So investing is going shopping for these assets. So it's more than cash. And that's where investing differs from savings on its own. So it's sorted. We would argue that the power of compound interest would be one of the most critical pieces of knowledge needed to grow our money. Whether it's saving, investing, or actually paying down debt, compound interest is what really supercharges our saving and our investing more so. So let's listen to a...
Have you ever wondered how compound interest really works? Let's take a look at the story of 2 friends and their saving and investing journeys. To demonstrate what their journeys will look like, we'll be using M&Ms in place of money to show how compound interest works. Both Anna and Paul are saving and investing for their future for the long term. They remain in the same aggressive fund for their whole investment journey. In this fund of mostly shares, the M&Ms compound at a rate of 5.5%, which takes into account fees, inflation, and tax. Anna starts contributing 20 orange M&Ms each year at the age of 18. Paul is not interested in saving for his retirement yet. He has other plans to use his M&Ms and does not invest any. Over the first year, Anna's 20 M&Ms earns her 1 blue M&M in interest. The next year, Anna keeps contributing 20 orange M&Ms to her fund, but now she is starting to earn interest on her interest, the blue M&Ms. This is what compound interest is, interest earning its own interest. Paul continues to use his M&Ms in other ways. Anna is starting to see the benefits of starting early with saving and investing. Te pai, Anna. Anna continues to invest until she's 41. She has now gained 523 blue M&Ms in compound interest after putting in 480 orange M&Ms over the past 24 years. She decides to stop contributing and let compound interest continue to do the work for her. Paul starts contributing 20 orange M&Ms each year. Has he started early enough? At the age 43, Paul and Anna are both receiving compound interest. Paul continues contributing as Anna sits back and watches her M&Ms grow. Paul is not too happy with his pool of M&Ms as he compares it to Anna's. Anna looks over to see Paul's jar and feels a bit bad for him that he didn't have the knowledge to start investing early. By age 65, Paul contributed 480 orange M&Ms over 24 years, the exact same amount that Anna contributed earlier. Yet Paul earned 523 blue M&Ms in compound interest, and Anna earned a whopping 3,146 blue M&Ms in compound interest. That's a big difference. Paul and Anna contributed the exact number of orange M&Ms, yet over time, Anna's M&Ms kept rising. This is the beauty of time when it comes to compound interest. Well, there you have it. The secret to compound interest is time. So if you can, why not think about saving and investing early and make the most of compound interest? It's not too late to start now. Kia ora.
One of my favorite videos, just to really demonstrate how compound interest works for us. And it really is about time. This video shows the difference that compound interest can make with a small amount of money. The earlier you start, the more your money can grow. And it's not too late if you're looking and thinking, I'm Paul, I'm 41 years old. Is it worth my time? It's absolutely worth your time. You'll still get the benefit of compound interest, but maybe just not as much as if you were the age that Anna started saving at 18. So when we think about our savings and investing, imagine the power our decisions can have when looking at compound interest and compound returns. We'll be getting more into compound returns as we go through this webinar. But essentially, compound returns means increasing the asset value and the distributions. And distributions can be things like dividends that you might receive from some of those assets. So it's not just interest that's compounding when it comes to investing, but it's also the returns. So in this first section, we've looked at the difference between saving and investing, and I hope you've really got to enjoy what the power of compound interest is. It's a really key concept, and we can access the video. I'm sure the team on Sorted will hop into the chat and just let people know where they can find that video later on. But it's a great wee tool, especially if you know any young people and you want to share it with them. I think it's a great place to start. So let's have a look at KiwiSaver, because KiwiSaver is a great place to start looking at the power of our investing and our saving and tying that up with our knowledge of compound interest. The real question with KiwiSaver is less about why we should be in KiwiSaver, but more why not. And in this next section, we'll unpack more about that. So here's your second poll for today. How do you feel about KiwiSaver? Let's pop that up on the screen and see how we are. Are we passionate about KiwiSaver? That would be me. I'm very passionate about KiwiSaver. You do it because you should. You're not sure or you're not keen. Now, there's no right or wrong answers. Just hop into the poll there and just share your thoughts. What about you, Tom? You'd be passionate, I'm sure.
Yeah, I think it's one of the best vehicles we have in order to grow our financial positions. But there's so many myths out there, and that's something that we'll be discussing later on, right? That you'll cover and that turn people off about KiwiSaver. So
for sure,
this information.
Yeah, let's share the results there so we can all say where we're at. And it's quite fascinating to see the different thoughts on KiwiSaver. There are a few people who are not keen, a very small percentage there, but I know people personally who are not keen on KiwiSaver. They have their reasons, and a lot of it's founded in history. Some people are unsure, and that can be about knowledge, not just not understanding what it's about, how to use it, how it fits for you, and those myths that we talked about there as well, Tom. Some people are doing it because they should. Okay, you know what? At least you're doing it. And hopefully we can get you to move a little bit beyond the should to that passionate side. And there are a lot of people who are passionate. That's really fantastic to see. I'm going to stop sharing that poll there. But that's really cool. I'm really pleased to see the different results there from that poll. I'm just having a bit of a look there. Hopefully that's gone. Excellent. There's a comment in the chat about superannuation in Australia and how our contributions are much lower, and you're not wrong. Australia definitely has their settings higher for the contributions, but not everything is perfect and greener over in Australia. The more you know about their superannuation, you can see that we have a fantastic vehicle here with our KiwiSaver. And KiwiSaver, it really has been designed for mainly two specific goals, one being your retirement. So that's the key thing. KiwiSaver has essentially been designed not as a savings account. We're not meant to dip into it too often. It's for retirement, and it's been designed to be left alone for as long as possible. However, we have been given the opportunity to dip into our KiwiSaver for our first home through that first home withdrawal option there. So it is good for that side of things. There's a few myths I can see coming through here on the chat as well. So we will be addressing some of these very shortly. So when it comes to our KiwiSaver, one of the biggest benefits here is you have 3 different groups of people contributing to your KiwiSaver retirement fund. You have yourself as an employee, you have your employer if you have one, and they'll be contributing as well. And we have the government as well. And it might not be a huge amount of money, but it's still something. And there's not much we can get for nothing. But this is a case where we do. So if we're contributing to our KiwiSaver, then the government will give you 50 cents to the dollar up to a maximum of 521 per year. If you are self-employed, then you can still invest in KiwiSaver, but you won't be getting that third person, that employer, contributing because you are the employer. So you can do that as well. When it comes to our KiwiSaver, there are 4 ways that our money grows. So this graph here that we're looking at is essentially a balanced fund, and it's showing a return of approximately 3.5% per annum annualized. So we can just see what this looks like as an experience of somebody who starts at the age of 18 and they work through their entire life up until age 65. So this is somebody starting out on a wage of, say, $35,000 a year, and they're contributing the minimum amount of 3% of their salary. After 47 years of working and experiencing some growth in their salary along the way as well, they would have close to $280,000 in their KiwiSaver account. This would have come from 4 different areas. So we have their own contributions from their salary, so that was 3% every year, that ends up being about $70,000. Their employer contributions will be a little bit less because there's a little bit of tax that tends to come off that one, and that is about $57,000. The government contribution, so that 521, would have ended up being around about nearly $16,000. And then investment returns from the market would be about $136,000. So those numbers that I'm talking about here do include the effect of fees, tax, and inflation, just to give you an idea. So what makes these KiwiSaver funds work so well is that effect of compounding. This is when our returns from our investments stay in our fund, much like the interest that we saw in the video just before, and they earn returns on the returns. So they just keep supercharging our returns for us in our savings and our KiwiSaver. But like we saw with the compound interest video, if we shorten the length of this graph and just slice it off a little bit to the right, then what would happen? We would see a slightly less return for us. And that's because it's about time. We can achieve a lot with KiwiSaver, but the sooner we start, the better. And there is a cost of delaying, and there are a lot of other costs involved as well. So what about inflation? So I mentioned that the numbers here include the effect of fees, tax, and inflation, and we do need to be aware of inflation because inflation does impact our spending power of our money in the future. So essentially, inflation is when the price of goods and services increase over time, meaning that our money buys less than it used to. It's like having the same amount of money, but it doesn't stretch as far because everything costs more. And we've probably experienced that quite a bit recently. Especially at the grocery store, we've seen the effect of inflation. But if I think back to when I was just a 6-year-old going to the local dairy and buying my sweets, my lollies, I remember when they used to be 5 lollies for 1 cent, and then it was 5 lollies for 5 cents, and then 1 lolly for 5 cents. I was not a happy bunny, that's for sure. So that was just a little experience of the effect of inflation as a child. But now as an adult, we see it more regularly than we probably would like to. That is a fantastic graph there that we can have a look at just to see the 4 ways that money flows into our KiwiSaver and understand those 4 different income streams. So let's get some of our facts right about KiwiSaver because there are a lot of common misconceptions out there, and these are holding people back from getting the most of their fund and their contributions. Myth number 1, we hear this quite a bit, and that is the government owns my KiwiSaver. The government doesn't own your KiwiSaver. I'm pleased to say KiwiSaver is part of your estate. It is in your name and no one else's. So hopefully that one can be cleared up nice and easily. Myth number 2, if a provider goes bust, I'll lose my money. If a provider goes bust, so one of who you hold your KiwiSaver with, let's think of some names, the big banks are some of them. You'll have your own KiwiSaver fund that you're thinking of there. If they go bust, then what happens is that they sell their book, which is their list of people who are investing with them, to another provider. Essentially, they sell you and your investment to somebody else, and you'll get notified of this change. You may have experienced this already when I think that, say, Kiwi Wealth was bought by Fisher Funds. So you might, if you were with Kiwi Wealth, you ended up being a Fisher Fund investor. Not that Kiwi Wealth went bust, but they did sell their book. But if they do go bust, the provider can't dip into your funds to cover their operating costs. Your funds are held in a separate trust and are protected by law. So you won't go down with them. You'll just end up with a different provider. And if you don't like that, then you can change to a different provider, that is. So myth number 3 is I won't have control over what happens to my KiwiSaver when I die. Well, as I mentioned before, KiwiSaver is in your name, therefore it's in your estate. So you have control about what happens to your KiwiSaver so long as you include it in your will. So we need to make sure that we include KiwiSaver as part of our will if you want something different to happen to it in particular. So you can do that. KiwiSaver can be a bit complicated if it's not addressed in your will, so it's important to do that. And there's also the aspect of KiwiSaver and divorce. So KiwiSaver becomes part of your relationship property, and so that can get a little bit messy as well. We will cover wills in our final webinar for this series, so we'll be able to have a look about how to protect ourselves in these sorts of situations. But there's some fantastic research on sorted and Te Arohanga order to find out more about wills and KiwiSaver and divorce. So you can find that out there as well. So have a quick look at the chat and see if there's anything there. I'll leave Tom to answer some of those questions in the chat if you like. And if you want to come on, Tom, and talk to any of those questions, then feel free to do that. I'd love to have you pop in. Cool.
Thanks, Unicia. Yeah, I can pop some answers in there, and then we'll be asking for those questions more in the Q&A sort of way to post questions at the base of your screen there. Let's see if we can collect the questions there.
Perfect. So I'll let you keep an eye on those questions as they come through the chat, so you can be a little bit more prepared than I am.
No, will do. Absolutely.
Thank you. Myth number 4. We often think that we've got ages until retirement. It's a long way out there. So far so that we often don't associate our retired person as our current person. So we have that real disconnect between me now and me in the future, me retired. And because of that, we are perhaps a bit too laid back about our retirement. And maybe we could be a bit more serious about our savings. So yes, we do have a long time to retirement, and that time can be used to our advantage if we take real action with our KiwiSaver. So maybe we're a bit laid back in that we only use 3% as our minimum, but in actual fact, is that enough for our retirement? Australia is heading towards 12%. Should we be doing something similar? And even if we can't do that as a country, as a legislation, from a legislation point of view, we can increase our contributions on our own. So we can do that. You may be receiving some tax relief with the recent tax changes that kicked in this month. Maybe that extra, maybe one of the lucky ones who gets that 90 per fortnight. And if that's the case, then maybe that could be going through towards your KiwiSaver. So one real cool tip that you can do is to hop onto the Sorted website and use the KiwiSaver savings tool and just see the impact of adding another percentage to your contributions and just seeing what a difference that makes over time. So yes, we have ages, but if we don't do anything, that will fly by quicker than we realize. So here we go. Here's our chance to ask some questions in the chat. There I can see Tom has been answering a few of those questions. Do you want to talk to some of the questions that are coming through already? And I'll keep an eye on some of the more other questions as well.
Well, one was KiwiSaver and relationship property. And so we just want to clarify that it definitely becomes part of relationship property in the case of separation and divorce. Unfortunately, what happens is it often gets overlooked. And then the other thing, another question came up about opportunities to invest beyond KiwiSaver, which you'll be covering a little bit later in this webinar. But just to say that lots of KiwiSaver providers offer non-KiwiSaver managed funds that are almost identical, but without the restrictions.
Yeah. I see a question in here or a comment about risk and market volatility. Absolutely, and that we saw that a lot through COVID. We saw our KiwiSaver balances drop quite significantly. And the real key there, though, is to get the difference between the fact you haven't lost money while that dropped. You lost value, you lost a number, but so long as you're not taking that money out of your KiwiSaver, which most of us aren't, it'll grow back again. Volatility, dips in the market, that happens more regularly than we probably realize. And I think because our KiwiSaver balances are getting so high, the media got onto that bandwagon quite quickly and it became a hot topic. So we were just more aware of it than anything else. In actual fact, markets dip probably 1 in every 5 years. So we will go through this again. And so you're not losing money unless you're taking money out. So, and if that's the case, if you're close to retirement and you're getting close to using your KiwiSaver, then talk to an advisor so they can help you time things out. You don't want to suddenly be taking everything out, but you can be taking a small amount as needed. Would you agree with that, Tom?
Yes, I absolutely. Another question that came up is there a maximum amount of money you can add? No, this is your account, so you're always allowed to put in lump sums beyond. It's just that the automatic contributions are set at certain percentages, but at any time you can add more money to your account whenever you like.
Yeah, absolutely. A couple of questions around conservative funds. So there's two different aspects there. One person asking whether or not they should switch to conservative if they want to withdraw to buy a house. Now, if that's something that's coming up really, really soon, like in the next few months or next year, then you might want to safeguard a portion of that portion into a conservative fund because you don't want it to be subject to the market volatility at that time when you want to withdraw the money. So that time it might be a good idea to have that portion you want for your deposit in a conservative fund, but the rest of it can stay invested however fits your risk profile. The other question there was around retirement and when you're close to retirement, should you be in a conservative fund? And I would say not likely because you've still got another 20 to 30 years ahead of you when it comes to your retirement. So you've still got a long time frame ahead when it comes to still investing while you're in retirement. I'm not sure if you guys can hear the siren going off in my background, but I live next door to the school and they have their alarm going off. So I'm sure everything is fine. And it's probably the test. All good. Any other questions in there?
Yeah, there's actually a fair bit. One question is, how is KiwiSaver used when we retire? Is it paid out in a lump sum or paid out slowly? And the answer is either. It's up to you, but more and more KiwiSaver providers are setting themselves up to give you regular withdrawals so that you can live off of your KiwiSaver nest egg.
Absolutely. So you can take it out every month. You can line it up with your superannuation payments every fortnight. It just becomes another income stream that you can take out. It's going to be amazing watching that happen as people learn how to actually access their KiwiSaver. But that's a really good time to talk to an advisor as well, just to plan that side of things, especially because you're probably looking at a good amount of money now when you get to retirement anyway. Your KiwiSaver isn't taxed when it's withdrawn. It was taxed on the way into your KiwiSaver. So that's really good. However, your returns on your KiwiSaver are subject to tax. So that'll be usually at your applied tax rate, so 28%, and that'll change as you earn less, which will likely be in retirement. Oh, so great questions, guys. We have I see a lot of questions coming through there, and hopefully we'll address a few more of them when we talk about investing in particular. But there are some fantastic tools on Sorted that you can use. One of the questions we often get asked is, what sort of fund should I be in? So you can have a look at this Sorted tool. It's only a couple of really easy questions just to use your KiwiSaver. So this is just actually looking at how the KiwiSaver savings calculator works. Apologies there. I was thinking about the next tool that's coming up. But I love that this tool is so interactive. You can change your contribution rates. You can add in a regular top up if you want, change your fund type. And you can also adjust your retirement years as well. So if you're thinking of stopping work at 67, for example, you can change that. And these are all adjusted for inflation as well. You can switch off the inflation adjustment on the tool if you like. You'd rather see things not adjusted for inflation, but I think it's quite helpful to leave that inflation tool tab selected there. So yeah, it's a very, very good tool to have a play around with just to see what your KiwiSaver balance might look like. So for KiwiSaver, it's about getting the most out of what's available to us and making an active choice. So being an active participant in your KiwiSaver journey. So first of all, it's about thinking about how much you want to contribute. Are you going to contribute 3%, 4%, 6, 8, 10? Maybe you want to contribute even more. Your HR can help you with a little bit of that, but if you want to contribute outside of those standard settings, you can set up an automatic payment on your own, just through your bank, straight to your KiwiSaver. So it's not too difficult. Your employer will be contributing as well. So it's good to identify how much your employer is contributing and how that fits into your KiwiSaver total strategy there. Then we want to think about picking the right fund for us. So finding the right fund type in your KiwiSaver is really key. We've mentioned conservative a little bit, so that one's come up already in the conversation, but there's also defensive, balanced, growth, and aggressive. And there are some even more than that. You can even find high aggressive or high growth funds available with your KiwiSaver now as well. So we can really start to get a bit more bespoke about what sort of fund works for us. The second step is to compare the different types of fees that there are, because fees will reduce our KiwiSaver balances. They're a cost. And so we want to make sure that we're not paying too much for that, especially when your balance is small. You'll see the impact of that really easily. Step number 3 is to consider what your KiwiSaver provider is offering you. So if you're paying a fee, what are you paying that for? It'll be for their active role in your KiwiSaver performance, I'm sure, but also they should be communicating with you. They should be sending you regular updates. You'll be reporting. There could be their social media things that they do as well. But what are they doing for you? And check that that's what you want and what you need. And step number 4 is to have a look at the fund's past performance. Now, unfortunately, past performance is not an indicator of future performance, but we can't help but look in the rear vision mirror. We can't help but just have a quick glance to see what have they done in the past, and that's absolutely normal. But don't use that as your sole reason for choosing a KiwiSaver fund, because you can't predict what they're going to do in the future there. So ideally, you want to find that fund type that is right for your situation, has reasonable fees, comes with good service and communication, and hasn't performed well below others. So keeping an eye on what that looks like. So here is what the 5 different fund types essentially look like when it comes to the risk that we have and the asset mix that we hold, also the market volatility, the potential for returns, and the time frame. So those are 3 key areas that we need to look at there. So the more you hold in more shares you hold in your fund, so that's the more growth and aggressive side of the table there, the bumpier your investing ride will be, which you can see that in the likely ups and downs graph there. So obviously the aggressive is way more up and down. There'll be some really high highs and there'll be some really low lows. Whereas the defensive and conservative side of the graph is a bit more smooth. And that's because they don't hold as many shares. It's more about cash and fixed interest, which are a bit more steady as she goes. But with the higher, the greater ups and downs, the more market volatility there is the opportunity for potential higher rewards, so bigger returns, which is the money bags that you've got there. But there's no guarantee, which is why why we've got the market volatility showing there. But the real key is about sticking to your strategy over a long term. So the longer you have to invest, so 10 years plus, the more of an opportunity you have to ride out the ups and downs that will happen in the market. Like most of us who've been through that COVID up and down, we've come through the other side. You've probably more than recovered from what you saw on the dip in your KiwiSaver balance. It should be well beyond that by now. That being said, the last month was a bit difficult as well, so you probably saw that happen, and we will recover from that as well. But for me, I've got another 25 years of work ahead of me. So I've got plenty of time to ride out those ups and downs before I need to start to withdraw from my KiwiSaver. So if you find a new fund, then it is actually surprisingly easy to switch. Whether you're switching within your KiwiSaver provider, so you're happy with your provider, you're happy with the fees, the service, and everything they're providing for you, but you just want to switch, maybe move from balance to growth or aggressive or the like. You can do that pretty easily online with your provider. Or if you wanted to switch with another provider altogether, then that is just a matter of filling in some paperwork, usually an online membership application form, and the provider that you're switching to will do most of the heavy lifting for you. I've been through that process quite recently. It didn't take too long for it to happen. More than anything, it took a few weeks before the money ends up switched between provider A to provider B. So there is a bit of a time delay that happens there. I'm not saying that we should just go and switch things willy-nilly. We do need to check that it works for us. So talk to people, talk to your current provider, talk to the new provider as well, and see if it suits you and what you're needing. So you may have heard the terms passive and active investing before, but what does it mean? Passive gets a bit of a bad rap, in my opinion. So people often think passive funds are people sitting on their hands and doing not a lot and being paid a fee for it. But quite simply, passive investing means that you're matching a market index, which in turn is trying to match the performance without fund managers specifically choosing individual investments to trade often. So passively managed funds are also known as indexed funds. You might find that one a bit more out there in the online and everything. And because they are index funds, they're generally cheaper. So you'll find passively managed funds amongst some of the more lower cost fund options that are available for us. But they're trying to match the market index and their performance because that market index exists for a reason. Whereas active funds tend to be given give the impression of noise. So they're in more of a noisy environment. So the managers are trying to buy and sell a bit more. They're trying to beat the market. So active fund managers are trying to get the best results by choosing investments that they think will beat the market and by trading them, so buying and selling. This generally makes them more expensive because you're paying for the manager's time, their research, and the trading costs. But if the manager is successful, then the higher returns can be worth those fees. So if you see the difference of fees, then it's generally to do with passive versus active management. And you'll be quite surprised, I guess, to find out who is active and who is passive when you have a look on the sort of website there. So, do you know what fund you're in? Let's have a look at this poll here. And I'm just going to have a quick look through the chat while you guys are hopping onto that poll. Oh, very cool. Got some good questions there. I look forward to answering those very shortly. So, do you know what fund you're in? Not in a fund, not sure. And then there's quite a few people. Good chunk in the growth and aggressive, which is good to see. Could be an indication of potentially the age of people we have here online. If you're not sure, there you go. Hopefully you'll be inspired to go and have a look at your KiwiSaver after this if you're not sure and actually find out what you're in. All right, let's end that poll and you can share the results, please, team. Yeah, it's fantastic. Is there anything you wanted to add to this poll results here, Tom? I'm really encouraged to see so many people in growth and aggressive. I think that's really fantastic.
Yeah, just to say that our KiwiSaver Fund Finder tool right at the beginning is really made to help people either choose the right type of fund for them or just confirm that they're in the right type of fund for their situation.
Absolutely. That's great. So definitely have a go with that KiwiSaver Fund Finder, just that type to see what's in there for you. And here we go. I think it's the next slide, actually. So how do you know what's best for you? There we go. This is the KiwiSaver Fund Finder. It's just got 4 easy questions for you to ask. And it's just trying to get an understanding of what your time frame is, because the more time you have, the more opportunity you have to invest in maybe something with a little bit more shares in there. Also wanting to know, how do you feel about losing any funds as well? So if you're feeling a bit nervous, then it will direct you more towards the balanced type of fund as opposed to a growth or aggressive fund. So that's quite a good step to have in there as well. But it's nice and easy, 4 questions, and it will give you a short answer of whether you're looking at a growth fund, aggressive, balanced, or whatever it might be. And from there, you can start to play through and see what happens with your KiwiSaver balance as well. It's a little note that pops up around fees, because fees are important to be aware of. We know that fees are going to be paid, so make sure that you're aware of how much you're paying and what effect that's going to have on your fund. And then also the other thing, a little pop-up will come as well when you search on returns, because it will remind you, just as I did earlier, that returns are not an indicator of future performance as well. So we need to be aware of that. There are some really good ethical funds out there. Mindful Money, as Tom has mentioned in the chat, is a great place to go to have a look at to find out more about ethical funds with your KiwiSaver. And that's a great place to start. So some good research on there. So any questions, hop into the chat and let's have a little look and see what questions we've got coming through. I'm going to have a skim and see what questions have already been in the chat. There was one comment about whether or not you can have only one KiwiSaver account. It's interesting because there are situations when you can have 2, and it's not because you've got 2 KiwiSaver accounts. It's usually because you've got one KiwiSaver account and one superannuation fund, which is slightly different. So it'll be I'm thinking of, for example, tertiary educations. They have their own style of superannuation fund. It's not KiwiSaver. You could find that you have another KiwiSaver fund on the outside, but you can choose to contribute to both, but your employer will generally only contribute to one, and you would only get one lot of the government contribution as well. And that one's quite funny because that depends on who puts in their application first, which provider puts in their application first on your behalf, which is usually the KiwiSaver provider, not the workplace scheme, just from my experience anyway. Cool. Tom.
Yeah, Lindsay's just written in about money left in Australia super since relocating here. One key thing to know is you will be paying fees on both sides of the Tasman there, and so it may be worthwhile to consolidate all your investments into KiwiSaver here locally. Have a look at the fees.
Yeah, have a look at the fees and also just check around the regulations of how and when you can bring things over. I know with UK pension transfers, there's a 48-month window to avoid the tax side of things. So there's a very short window often available for these sorts of things as well.
With Australia, it's a little bit easier, thankfully.
That's good. That's nice to hear.
Portability is a lot easier than from the UK.
Yeah, fantastic. But yep, have a chat and with an advisor or with an expert in that area for sure. What else? What other questions have we got?
Keenan was just asking, once you get to retirement and start withdrawing, will the remaining KiwiSaver still be earning interest? Absolutely. And that is actually one of the features here, because by leaving your investments still growing, you're able to draw them down over much longer periods of time. Yeah, so you might retire, for example, with say $300,000, but over your retirement, you might end up withdrawing and living on, say, $500,000 because it keeps being invested over time.
Absolutely. So you'll still be getting those returns, and you'll be wanting to try and beat inflation with those returns as well. So, yeah, it can definitely be managed. That's for sure. I think there's someone asked a question, what's the difference between KiwiSaver and super? So superannuation funds are another name for a workplace savings scheme quite often. But when we talk about super, quite often we're meaning New Zealand super, which is the benefit or the pension that gets paid in retirement. So they are 2 different things. Your KiwiSaver is your funds that you've been contributing, and then superannuation is the benefit that you get once you are eligible, which is usually the age of 65. But yeah, there are a lot of names that come up, right? Which is why the myth busting is so important. So hopefully we've busted a few of those myths for us. We've covered the KiwiSaver basics, and you know how to find a fund that is suitable for you. The sorted website is the key place to go there to find out more and just to really play around with some of those tools. But let's have a look about investing beyond KiwiSaver, because KiwiSaver is a great place to start, but let's go beyond that. So let's launch another poll. If you had to make a decision about investing right now, how would you feel? And to be honest, you might feel a bit different now than you did maybe 45 minutes ago when we started this webinar, because you've had a whole bunch of more information there. But how do we feel? Okay, we've got quite a few people popping in there. So we've got lots of lost, as if I have some idea of where to start. I know where to get support, that's good. Relatively competent, and it's a very small percentage thinking, saying they could invest like a pro. That's cool. Excellent. Let's share these results, team, so we can all see what's going on there. Just so you know that you're not alone. Essentially, we all are at different parts of our investing journey. Even, yes, I'm a financial advisor, so I should be saying yes, I can invest like a pro. But we're always learning. There's always new things to learn along the way. It's probably a little bit of imposter syndrome slips in there as well. But I know where I can get support. Yeah, Tom.
The key thing I'd mention here is that for funds like KiwiSaver, or again, many of the providers offer non-KiwiSaver versions of the same funds, we actually are paying fees for professional managers to manage our money for us and to make investment decisions. We have some good visibility about what they're choosing, which companies we're investing in, and where our money is flowing, but we are really utilizing their expertise. So we don't need to be pros here.
No, we don't. And even the pros know other pros. We have research houses that we can tap into. If somebody asks us a really complex question that we don't know the answer to, that's okay, because I know where to go and find out that information is needed. And then it's up to us to break it down and make it digestible for people. But we're all at different places, which is a really key thing to know. And I'm really pleased to see that most people know where they can go to get further advice. So maybe you're in the position to start a managed fund as like a sidecar savings account that sits alongside your KiwiSaver, because obviously KiwiSaver we can't access until we're 65 currently. So we might want to retire early. And if we did, what would that look like? How much would you need? So having a separate managed fund might be a way of allowing you to have that early retirement if you want. So there are some basic ways that we can get started when it comes to maximizing our investing.
Investing. Does it sound fun or intimidating? Well, if you've got KiwiSaver, then you're already an investor. Ka pai koe. Here's the top line on investing. Investing is when instead of putting your money into a bank account, you put it into things called assets, which put money back into your pocket over time. There are different types of assets. Traditionally, these would be shares, bonds, cash, or property. Then there are alternative assets like gold, art, or cryptocurrency. The reason people invest in assets is because they can produce an income and grow in value over time. It's important that they grow more than any costs, taxes, or inflation. Otherwise, it's not even worth it. So, how do you get started? There are 5 steps. Tahi, you've got to think about your investment goals. Why are you investing? Is there something that you're saving for, like a house or a waka? Working this out at the start means we can invest in a way that helps us reach those goals. Rua, what risk can you take on? Think about when you'll need the money. The longer you're investing for, the more time you have to ride the ups and downs of a higher risk investment. Lower risk investments, like bank deposits, are less likely to suddenly fall in value than higher risk investments, like shares, so they're better for short-term goals. But if you're willing to tolerate higher risk, you could get even higher returns in the long run. Is there any chance that your investment could lose value, or that you don't get your money back? Yes, absolutely. It pays to understand the risks, because no investment is risk-free. Remember, if it's too good to be true, then it's probably not true. If an investment is promoted as low risk with high returns, then it's probably a scam. And investing in it is as good as guessing, gaming, or gambling. And you don't want to do that with money that you need. Ever heard of the phrase, don't put all your eggs in one basket? That's step toru. Diversify. Don't put all your money in one place. Spread your risk and diversify your investments. Mix it up with investments here and internationally and in different industries. Then, if one investment goes pear-shaped, your other investments will keep you from losing too much. Fa. Choose how and where you'll invest. You can pick your investments yourself via one of many DIY online platforms, but you'll need to be clued up about the share market, business, or funds you're investing in. Or you can also get a professional fund manager to pick investments for you. In a managed fund, your money is pooled in with other investors, and a fund manager looks after it. This is how KiwiSaver works. Rima, invest regular amounts. Slow and steady wins the race. Don't try and win big by trading often. Put small amounts regularly into your investments and watch them grow steadily over time, thanks to compound interest. That's a lowdown on investing and how to get started. So remember, set your goals, understand the risk, diversify your investment, choose how to invest, and invest little and often. So now you're ready to be an investor.
Fantastic 5 steps in there, but it's really key for us to know why we're investing. When we know why we're investing, we can work out what capacity we have, and we can start making those active choices to suit our lifestyle. So we can understand that risk. All that we've talked about in KiwiSaver, it applies straight over here when it comes to investing. So your risk profiles and things like that. Diversification is that key thing, and that we get that with our KiwiSaver, with our cash, our bonds, our property, and our shares. That's the diversification that we get. If you were to download how many different assets you're invested in with your KiwiSaver fund, you would probably end up with a few hundred pages. There is a lot there. So I know some funds would have 4,000 different investments. That's diversification. It would be very hard for you to pick 4,000 different assets on your own, whereas a managed fund can do that for you. Markets do have ups and downs. And we've seen this with our KiwiSaver, and any other investments will be affected by this as well. But so long as you've put in that hard mahi, you've got your settings right, you've picked the right type of fund, and you understand the risk that you can work within, then you'll be within your comfort zone. So you won't be too panicked about these sorts of things, and that's really key. We have a lot of tools on the Sorted website that you can use to look at your KiwiSaver, but the one that I really love is the investor profile. So you can understand how these different terms, so the defensive, conservative, balanced, and growth, fit within investing. Now this one's a bit more than the last calculator, the last tool we showed you that only had 4 questions. This one I think has 7. So it goes a little bit further to understand whether or not you have other savings, how stable is your job, and things like that. So you can really start to understand how investing fits with you. And then you can apply that to your investing side of things and talk to an advisor if needed. But it's a great tool to have a look at there. I encourage you to have a look on your own time as well. So investing with regular amounts is also really key, and we do this with our KiwiSaver. So every time you receive your pay, you have a small amount go across to your KiwiSaver, meaning that sometimes the market is good, sometimes the market is not, but you are investing regardless. So that means you're getting the benefit of dollar cost averaging. So that means you are going to get the benefit of the market ups and the market downs as well. So that means that we're putting the money in all the time. If you're not sure how much you can be putting in, hop onto the Sorted calculator and have a play around with your spending plan that we talked about last week, and see what you can do to make things work for you. All right, I was trying to get to the Q&A there because I could see that we have a bunch of questions that people are keen to get in before they have to go back to work, and we are on the final run of our webinar here. But I'll have a look at the I can't answer the question, why did the government stop the 1,000 kickstart? I'm guessing because it didn't fit within their budget more than anything else.
Well, there was that, but also it incentivized people to join. And once we had lots of people joining, actually, it didn't make sense to. And it's really about now the incentives need to help people to contribute enough so that they can really have a good result.
Very cool. There's a question there about cryptocurrency, and currently crypto is not included in KiwiSaver funds, but they may be included in other managed funds. So you can find out if it's something you're interested in, see if they're investing. It is high risk, so it's definitely going to be in that more aggressive side of things, but it's not included in our KiwiSaver funds at this stage.
Actually, there is one, that I know of, Cora, and there probably are others who are now they're including ETFs that track the spot pricing for cryptocurrency like Bitcoin.
That's how they're getting it in there. There you go. There was a question about house deposits, but I actually didn't see that question. So did you see the house deposit question pop through, Tom?
Yeah, there were a couple different ones, and so we just want to make sure we're answering that one. Maybe we could get it answered again. There's a few things. Yeah, the house deposit question. Just want to make sure that we're
maybe one of the team can find that for us and just pop that into the chat.
In the meantime, there's another question here, a worry about the future that many of us probably share about climate change, et cetera, and how that's going to affect savings and investments. And I would just say on that when we're investing, and particularly in shares, we're actually investing in companies that are operating in this environment. And we really do, I don't think there's anybody on this call who might not think that those companies will adapt to the environment going forward, the changes that are coming up, and continue to find ways to make money. And therefore, we are sharing in those profits, and really we're able to invest in a wide array of really good companies, including those that are part of the solution, like renewables, for example.
Exactly. I mean, ethical investing comes into it as well, but even from an accounting point of view, companies have different standards that they have to maintain for climate change with their reporting. So we'll see that come through in investing as well. So we will see a lot of that. There was a question that I thought that was an easy, relatively quick answer before we finish up for today.
A couple of times a question has come up on whether it's better to put extra money towards a mortgage or in KiwiSaver. And financially speaking, it's really good to take advantage of those incentives that Unicia was talking about, whether it's your employer contribution, the government contribution. You don't want to leave that money on the table. Once you have those incentives going in, though, any extra money above that can be funneled towards your mortgage. And so you get that added advantage of retiring your money, your mortgage, that much earlier.
Yeah, and we would often say as well to make sure you do both. So pay off your mortgage as fast as you can, while also taking care of your retirement. So many people get to retirement thinking, oh, I'll just downsize my house. But in actual fact, we've put so much time and effort into our house, we probably don't want to downsize. Or when we downsize, we actually end up spending the same amount of money. So putting your hopes onto that one asset can leave you struggling for your retirement. So do both. Focus on your mortgage, but also focus on your retirement as well through your KiwiSaver. So we have covered a lot of things today. We have looked at how to get the most out of our savings and investing, looking at our KiwiSaver in particular, and being really, really thoughtful in how we invest. So it's been really, really great to have you here with us. Remember, there are plenty of resources online, especially during Sorted Money Month. There is so much going on all the different channels, to be honest. It's almost overwhelming. But find what works for you. Hook into the different sessions. We have 2 more coming up here as well. So the next couple of Wednesdays. So please join us for those. These are just the tools that we've looked at today. So there are plenty more tools available for us. And we just look forward to seeing you next time. But if you've got any further questions, please hop into the chat. Tom and I will hang around for just a little bit longer.
Absolutely.
We can answer as many questions as we can. But otherwise, tēnā te mihi atu kia koutou, Māori ora kia tātou. I'm really pleased that you joined us. Thank you, Tom, for joining me as well. It was really fun having you here. It created a whole new feeling, and I quite enjoyed that.
Great to be a part of it.
Yeah, let's do this again. Maybe next week.
Yep.
Yeah. Kia ora, guys. Have a fantastic time. And we'll stop the recording very soon.